Now, today's presentation is about the FATCA and CRS requirements within the DIFC. As you may be aware, that the reporting requirements are to be completed before 31st July as per the latest circular issued by the Registrar of Companies of DIFC. Essentially, we'll be dealing today with the FATCA and CRS reporting obligations as they apply to DIFC. Now, before we start, we request you to keep your microphone muted during the session, and we also request you to keep all the questions to the end, and then you can unmute your microphone and ask those questions. Now, this particular presentation will be recorded, and then you need to make sure that your speakers are not muted, but microphone is muted. Now, this presentation is very generic in nature, just for creating an awareness. But these are all professional matters requiring professional advice, and also a lot of efforts need to be made to implement them across different organizations. So please do not treat this as a professional advice, and then you should consider this as a kind of an update and awareness, and make your own decisions. So my name is Narasimha. I'm a partner. I'm in the compliance and risk consulting practice at Crowe DIFC. And then I have a legal background for about 25 years before moving here to Dubai about 10 years ago. And for the past 10 years, I've been specializing in regulatory compliance and risk management areas. Now, these are the learning objectives of today. FATCA and common reporting standards, you must have heard on a number of occasions, probably on quite a few occasions. Whenever you're opening a bank account, you need to necessarily fill up a FATCA form or a CRS form, declarations, and probably you might have done that also. And there is a huge amount of literature also that's available in the public domain. So what is the purpose of today's presentation? The key purpose is on 21st May 2020, that's about three weeks ago, the Registrar of Companies issued a very detailed guidance on the FATCA and CRS reporting compliance within DIFC. So our focus of our presentation today will be on this particular guidance issued by the Registrar of Companies and what is its implications or potential implications of this particular guidance. So we'll be reviewing the entire FATCA and CRS related obligations with a reference to this particular guidance issued on 21st May 2020. So these are the references of various provisions that are taken into consideration in this presentation. One is Common Reporting Standard Law, DFC Law number 2 of 2018, Common Reporting Standard Regulations, and Operating Law, DFC Law 7 of 2018, and DFC Guidance Notes dated 1st May 2020. Now, there are a couple of key aspects here which actually need to be taken into consideration. These are all recent regulatory developments, no doubt, including the Operating Law, DFC Law 7 of 2018, which empowers the Registrar of Companies with various powers in terms of the implementation of various legal provisions like this, which are within his jurisdiction.
Okay.
Now,
thank you.
On 21st May 2022, developments have happened in DIFC. One, DIFC Registrar of Companies has issued a detailed guidance on FATCA and CRS. The second thing is on the same day, registered company has also issued a letter to several authorized firms and also certain non-financial entities within the DIFC. Now, why this guidance has been issued? What is the purpose behind it? As you are all aware, the Foreign Account Tax Compliance Act is a US legislation implemented across the globe through intergovernmental agreements. And UAE also entered into agreement with US for implementation of this particular FATCA related reporting obligations within UAE. And that intergovernmental agreement becomes the basis for implementation of FATCA within the DIFC. So far as common reporting standards are concerned, they are standards issued by the OECD. This is as part of their overall efforts to curb the harmful tax practices. Pursuant to the OECD standards, DIFC, in fact, in the commitment given by the UAE government, DIFC has enacted Common Reporting Standard Law in 2018 and also Common Reporting Standard Regulations. Now, when you look at the legislative basis for FATCA, essentially it is US legislation. While Common Reporting Standard is actually domestic legislation, which has been actually implemented in DIFC also through DIFC Law 2018. But the underlying purpose of this both the laws is to curb certain harmful tax practices across the globe. Both the laws have, in fact, different definitions. What is financial institution, what is non-financial entity, what is passive entity, what is active entity. A huge amount of classification is there in terms of what type of entities are governed by this particular law, reporting obligations. Not only the different types of accounts, financial accounts of different types, but there is one difficulty. The difficulty is that these definitions are capable of being interpreted in different jurisdictions in different manner. Same definition, which is contained in one particular, which is interpreted in a particular manner in a civil law jurisdiction, may be interpreted in a common law jurisdiction in a different manner. Maybe in an Islamic law jurisdiction, it may be interpreted in a different manner. So once again, the same inconsistency, which has been actually, taken advantage of by various taxpayers in terms of structuring the tax model or tax avoidance structure, will once again come in. So what OECD has done is, they have in fact, brought out the commonality between FATCA and then CRS. And they issued a huge amount of commentary on both the legislations, particularly the reporting obligations, how various terms in both the various defined terms in both the legislation have to be interpreted consistently throughout the world. So the basis of this guidance on 21st May 2020, when you look at this particular guidance, this guidance in fact refers to this commentary that has been issued by OECD. In fact, they make it very clear that in the guidance, when you read, that the registrar of companies in fact advises that everybody should take that commentary into consideration. The examples given there for interpreting the various definitions that are available, which form the basis for both the legislations. And also, there are very significant similarities between FATCA and CRS. While FATCA actually directs reporting of accounts or reporting of assets of US taxpayers, Common Reporting Standard is intended for such an automatic reporting to happen for other countries. So ultimately, the objective behind both the legislations is to ensure that right tax is paid in right jurisdiction. That is the basis. That is the reason why there's a reason for achieving kind of consistency in terms of reporting, consistency in terms of understanding the definitions and interpreting those definitions. This is where OECD has issued elaborate guidance, and commentary, FAQ, so many things. The DIFC ROC guidance actually provides links to these particular commentary issued by OECD. Thereby, in fact, the ROC guidance incorporates by reference the OECD standards into DIFC. So it is not a case, everybody interpreting differently a particular term. Everybody has to interpret every term in accordance with the meaning as assigned by OECD. So this is what was sought to be achieved, and this is the reason why guidance has been issued. Simultaneously with the issuance of guidance, the registrar of companies also issued a letter. Probably many people might have received this particular letter, or they might have received an email communication saying that, particularly saying that basing on the latest developments or understanding, we believe, the ROC believes that a certain entity should be classified as investment entities having relevant reporting obligations, and advises the relevant firms to take this into consideration, and also the guidance issued. So all those firms which have received this particular guidance may have to pay further attention, because it's a kind of preliminary assessment that has been made by registrar of companies, that registrar of companies treats them or believes that these are investment entities. Now, this is where the role, functions, power of registrar of companies under the operating law becomes important. The operating law empowers registrar of companies to actually implement the laws falling within his jurisdiction, and he has got power of inspection, power of imposing fines, and also powers to issue guidance. Operating law further says that if there's a contravention of a guidance issued by a registrar of companies, that itself will have certain consequences. That means the guidance that is issued by registrar of companies as a legislative basis, the contravention of which can potentially lead to certain consequences. So this is a guidance that needs to be taken into consideration with all this seriousness which it deserves. And then while reporting for the current year, all the entities are being advised by ROC to take this guidance into consideration. Now, in addition to the registrar company is actually the relevant authority under the DIFC common reporting standards, thereby he has enforcing powers so far as common reporting standards law is concerned. Now, with this background, let us see what the ROC is trying to achieve. Now, as I said, the ROC very specifically says in its guidance that there are significant similarities between FATCA and CRS. And secondly, the ROC also provides certain guidance in terms of how the reporting has to be done. Now, let us quickly look with reference to this particular guidance, what common reporting standard as it applies to DIFC. Now, this DIFC common reporting law applies to all reporting financial institutions and also any account holder of a reportable account, which is with a reportable financial institution, reporting financial institution. Now, this law had a retrospective effect certain accounts existing as of 31st December 2016 have been classified as pre-existing accounts, and all accounts opened after 1st Jan 2017 have been classified as new accounts under this particular law. Now, the law also contemplates the reporting to be done by certain financial institutions. I have extracted here the definitions as provided by the guidance. There are these definitions are simplified form of the definitions as contained in the CRS. Now, financial institution refers to either a custodial institution, depository institution, specified insurance company, or investment entity. Now, while custodial institution, depository institution, or specified insurance company may not pose a difficulty in terms of identifying who they are, the investment entity requires a more elaborate consideration. That is what is given in this particular guidance. Now, investment entity means any entity that primarily conducts a business involving managing, investing, reinvesting, or trading in financial assets on behalf of the customer. When you see an example given by the ROC guidance, in a particular situation, in fact, the guidance says that the investment advisor can also fall under this particular definition of investment entity. And then not only any entity which conducts these things, but any entity that is managed by any of the reporting financial institution. The guidance also lists what are the types of entities in DFC which may potentially fall under this particular definition of investment. Financial services firms which have these licenses, like managing a profit sharing investment account, dealing in investments as principal, dealing in investments as agent, managing assets, managing collective investment fund, providing fund administration, operating crowdfunding platform, providing trust services like that. The guidance also lists investment fund vehicles, single family office, holding company, and proprietary investment company also under this particular definition. It says that these entities which carry on business under these licenses have to particularly examine the potential of those entities falling within the definition of investment entity, thereby having reporting obligations. Now, taking into consideration that very specific illustrations have been provided by the DIFC, and also several examples have been provided by the OECD also in its handbook. Now, the interpretation of the various provisions of the FATCA or the CRS becomes much more challenging. So probably the impressions or the advice that is taken last year or before that may not hold good anymore. So it may require a fresh look or fresh interpretation, taking into consideration very specifically the guidance as provided by OECD. Now this is where, let me take you through a couple of examples. And also, there's one more challenge that is coming this year. By June 30th, every entity is required to submit a notification under economic substance regulations, which is also part of the global tax reforms. And by July 31st, the CRS and the FATCA reporting also has to be made. Sometimes there may be an alignment that may be required to ensure that the reporting happens in a consistent manner and having regard to the business structure or the way in which the various agreements have been structured. Those need to be necessarily examined, sometimes with the reference to economic substance law also, where it is required. So when compared to last year, this year reporting obligations could be much more challenging for certain firms. Now, what is more important here is to understand the way in which reporting has to be done. What DIFC ROC has done is, they have in fact published sample reporting forms also. So those sample reporting forms also need to be taken into consideration for deciding the various inputs that need to be provided in the return. Now, as per the guidance issued by US Central Bank pursuant to common reporting standards, now the resident person in UAE for the purpose of tax residency means, so for the individual is concerned, any UAE national or any individual who is resident having a valid Emirates ID or valid residence visa. Now, any entity means any entity which is incorporated, registered, managed or controlled within the territory of UAE. This is the tax residency concept as given under the common reporting standards. In fact, when we are actually currently advising on economic substance regulations, the notification form, particularly 5.1 and 7.1, is posing challenges to several entities which are particularly branches of foreign companies as to what should be the tax residency or what should be the right declaration to be made, whether the income should be considered as taxable in any other jurisdiction. These kind of issues are coming. Now, similar situations are also, we have seen last year also in FATCA and CRS also, when actually you are trying to interpret and try and input these return into the system. In addition to that, Article 12 lays down in summary what are the obligations of reporting financial institutions. One, of course, collecting and reporting required information in accordance with the DIFC Portal requirements, and establishing and implementing appropriate systems and internal procedures for CRS compliance, maintain records of the steps taken, evidence relied on, retaining all records, providing English translation to authorities when required, and notifying the any reportable persons prior to 20th February of each year regarding the account that they became reportable and providing the relevant information. Now, these processes become much more important now, considering the elaborate guidance that has been issued and clearly indicating that the registrar of companies is exercising its powers under operating law as well, in addition to the common reporting standards law. The common reporting standard obligations or requirements contain a set of due diligence obligations how due diligence has to be conducted so pre-existing accounts are concerned, how the due diligence has to be conducted in respect of new entity accounts, and certain special due diligence rules. For want of time, actually, I'm not going through the each one of them, but the underlying purpose is to actually get the right kind of information from the clients and also from the internal records regarding the identity, nature, or the value of the transaction to be reported, or value of the account to be reported, and all these details have to be done taking into consideration due diligence. Due diligence, as you know, means reasonable verification. So every entity is now required to make, every reportable financial institution is now required to make a due diligence and also input that particular information into the reporting system. Now, what about FATCA? As I said earlier, the FATCA legislative basis of FATCA is essentially the US legislation. There are several definitions, in fact, in FATCA which look similar to CRS, but there's a difference. Now, the foreign entities here means entities which are foreign to US. They broadly fall under two categories: foreign financial institutions and non-financial foreign entities. Both have two different types of reporting obligations so far as FATCA is concerned. So far non-financial foreign entities are concerned, whenever they are maintaining an account with a financial institution, they are supposed to give a certain declarations regarding their status and if there's a US taxpayer interest is there, those details have to be provided. Now, financial institutions, so far as FATCA means any institution that accepts deposits or holds financial assets or is engaged or primarily in the business investing, reinvesting, trading in securities, partnership interests, commodities, and all these things. Essentially, the managing assets type of business, investment businesses. Now, all foreign financial institutions are required to enter into agreement with IRS, undertaking to do the due diligence procedures and report annually. This was the original intent of the FATCA legislation. Later, what US has done is, instead of doing that, they directly entered into agreements with intergovernmental agreements with various countries. And by virtue of the obligations under that particular intergovernmental agreements, the relevant countries started enforcing the FATCA related obligations within their territories. Now, in the event of non-reporting, there is a potential of the withholding of up to 30% of the value of any transaction where the US financial institutions get involved. Now, there are different types of agreements, Model 1 and Model 2. Now, UAE has adopted Model 1 intergovernmental agreement, and accordingly, UAE Central Bank also issued detailed guidelines relating to this particular implementation of this intergovernmental agreement. And that is the basis on which, in fact, DIFC is also enforcing FATCA. Now, while FATCA and CRS look similar, broadly from intended purpose to be served, there are several things which are common between FATCA and CRS. So OECD intended to achieve a kind of a uniformity in terms of the reporting obligations arising under FATCA and CRS, and also to ensure that there is a common understanding of various defined terms across jurisdictions. While doing so, in fact, OECD commentary points out certain differences or certain way of interpretation of certain definitions which are different from FATCA and CRS. The ROC in his guidance clearly points out to this particular aspect very specifically, saying that while FATCA and CRS have got significant similarities, it is also necessary to note that there are some differences as well. Therefore, the OECD commentary needs to be taken into consideration for the interpretation of FATCA and CRS. The way in which the categorization of various finance institutions, there is a slight difference between how the FATCA looks at and how CRS looks at. Similarly, reportable jurisdiction persons, there's a difference. One, of course, the US taxpayers, while others can be the taxpayers in other countries. So far as CRS is concerned, what are passive non-financial entities? Who are non-reportable persons? Who is a related entity? There are quite a few differences. Now, let us pause for a while and think about what are the consequences of this. When a legislation is passed, normally the legislation may contain within itself a guidance as to how it can be interpreted. For example, if you take DFSA rule book, particularly General Module 6.2, General Module 6.2 specifically states how the DFSA rule book has to be interpreted and understood. Similarly, when you get economic substance regulations, the implementing regulation 215 of 2019 very specifically says what approach needs to be followed while interpreting the provisions under economic substance regulations. So far as FATCA and CRS are concerned, till now, there was no specific guidance as to how this can be interpreted. What should be the basis of interpretation? Thereby leading to a kind of different understanding among different countries or different entities. Now, by virtue of this guidance, the registrar of companies actually referred to the OECD, the handbooks, the commentary, and specifically guides the entities within his jurisdiction to interpret every provision under FATCA and CRS in the light of that particular commentary, that particular guidance as provided by OECD, thereby taking out any other way of interpretation of this particular legislation or various defined terms. So necessarily, it may require a revisiting, at least in the case of some companies, to make sure that whatever the declaration they have provided for opening their bank account is correct, and also whatever reporting obligations they have may need to be revisited. This is what the registrar of companies is indicating through his letter dated 21st May 2020. So now you have very, very clear basis of interpretation of FATCA and CRS. The legislative basis is the guidance. The guidance has been issued by virtue of powers conferred by ROC under the operating law. Therefore, it has statutory basis. And the guidance specifically refers to or advises specifically that the commentary given by OECD should be the basis of interpretation. When you go and see the commentary, they run into hundreds of pages. The implementation handbook published regarding CRS itself is approximately about 175 or about 180 pages, containing several illustrations, examples as to how each one of these terms have to be interpreted. So now there is no other way of interpretation except the interpretation as provided by OECD. Within the DIFC, this is very clear on account of the guidance that is issued by the registrar of companies. So the whole basis of current presentation is to just make the high-level review or high-level indications what the guidance is and how things have changed from last year to this year while we are reporting under the FATCA and CRS through DIFC Portal. Needless to say that there are certain penalties and consequences for non-compliance or contravention, and then it could be, the even registrar of companies may inspect, and DFSA may also look into contraventions where the authorized firms have contravened and are entities falling within its jurisdiction of contravened, and where there are compliance officers, they have an independent obligation of looking into these breaches. If there are any breaches, then then they have an obligation to report those breaches to DFSA. So the current situation is that there's a lot of enforcement that has come into place so far as FATCA and CRS are concerned. So I'll stop my presentation here and would like to take some questions as to, from the participants, and probably, we can try to.
Hi, Narasimha. How are you?
Fine, thank you.
Great.
Narasimha,
I have one question. What is a reportable account under CRS?
Reportable account under CRS. Basically, the reportable account is an account that is held by a non-resident person. The non-resident person is a person who doesn't satisfy the tax residency requirement as per the central bank guidance. If it is an individual, then that individual whether he's having a residence visa or Emirates ID. If it is an entity, then whether that entity is registered, incorporated, or managed within UAE.
Okay, so any individual who is holding the Emirates ID and visa, he's a tax resident of UAE.
If it is an individual account.
Yeah. Okay.
If that individual is having an account, then this is the basis.
Okay, and for entity?
For entity, any entity that's incorporated, managed, and within UAE. This is how the central bank guidelines say.
Okay, and let's say for an individual who does not have Emirates ID, but he's not falling under OECD countries, then and he don't have any accounts in OECD country, then also it is not a reportable account, right?
No, let us concentrate only on DFC and UAE. Now, in UAE, if a person doesn't have residence visa, obviously he's a non-resident. Okay, this is by virtue of law.
Yes.
A non-resident cannot have a resident account within UAE.
Okay. But if he does not have any account in OECD countries, still it's a reportable account or what? If he's a non-resident.
No, let us not extend to OECD countries because there are 35 countries in OECD, this thing including so many big countries. And in addition to there are several countries who adopt the OECD standards. So I mean, it is not that is not the basis of the residency concept here. Tax residency is a concept basing on either the individual having a substantial business or income from in a particular jurisdiction, or an entity having a particular this thing. So when you view from tax residency perspective, you see from that angle.
Interest of time, Mr. Das, if we do not have any question, then maybe we can wrap it up now.
Okay.
Any closing comments?
Would you like to give some closing comments taking into consideration the way in which legislation is changing, interpretation is changing, so many legal reforms are taking place, and what kind of challenges that are going to pose, in addition to the post-COVID situation, which is anyhow evolving?
Yes, I think Mr. Das has covered very comprehensively in terms of the applicable laws and regulations which apply to all of us. I would just want to wrap it up, given the COVID-19 situation and the difficulties which all of us are going through. We need to have a clear strategy, and the clear strategy has to have the defined approach. In my view, one needs to manage the cash flow. That's number one. Manage the cost. The third thing is bring more business. Fourthly, comply with the laws and regulations. There are many more laws and regulations in the pipeline, like the corporate tax is also likely to come up very soon. And then lastly, but not least, we need to follow directions given by the government, and we need to also follow the directions given by the rulers of this country. So provided we are in compliance with the laws and regulations, we'll be able to sustain our business for a foreseeable future. Right. So thank you very much for
Sir, sorry. So one question has come up on the chat box. I'll address it for Mr. Mohammad Arshad. If an entity is an active NFFE but is having US indica, will it be reportable or not?
There are two aspects here. If an entity has US indicia, then that particular account becomes reportable under FATCA. So necessarily, in my view, it needs to be reported.
Sir, do we have time for one more question?
Yes.
Sir, Mr. Ajit Matthew has asked, are FIs under the obligation to verify whether a customer has remained resident in the country which the customer has provided proof of residence? For example, in UAE, a person can retain residency by visiting once a year. Yeah. Yes, sir. Should I repeat again?
Yeah, I understood.
Yes.
See, there are two aspects here. And this concept of tax residency has to be examined with both. One, no doubt a person may retain his residency based on the immigration law by visiting once in a year. But when you look at, the whole intended purpose that needs to be served here, it is the obligation of the financial institution to conduct a due diligence based on its anti-money laundering records to identify the reportable accounts. So it's not just only the residency which is going to determine this. It is quite possible that there may be other factors that need to be taken into consideration. So, except this kind of a thing, if there is nothing reportable, then but that's a different issue. But this needs to be identified with reference to that particular account. First, in fact, all the participants to leave their mail ID and their name in the chat box so that we can quickly share the presentation also and communicate with you. So I request all the participants to kindly, before leaving, to actually post their name as well as mail ID in the chat box.
I hope you have gained the knowledge from information that Mr. Das has shared with all of us today. And thank you very much for being in this event.